morning, ladies and gentlemen, and thank you for joining us for our 2021 Outlook. The last 2 years have been extremely tough for our investment approach. Many of you would have noticed the pleasing turnaround in our performance over the last 6 to 8 months. However, not much of today's presentation is going to be about that. We're going to be looking forward and explaining the opportunity we see in the future to you. Our presenters today are John Gilchrist. He is our Deputy CIO. He's a fund manager on the Stable and Diversified Income Fund and has been in the industry for 27 years. Mikhail Motala joins him. He's been with PSG for 6 years and started his investment career with us, and he's an analyst and fund manager on the Flexible Fund. With our presentation today, we'd like to explain to you that this rebound we've seen in equities and investments we've made due to our approach is just the start of what we believe will be a multi-year shift into the previously unloved areas in the market. Mikhail and John will demonstrate why we anticipate attractive returns not only from SA Inc. and bonds, also from global equities. The cornerstone of these attractive returns are the starting yields, both from a dividend and a bond yield point of view. Compared to the SA repo rate at 3.5%, we think that these yields should make you sit up and pay attention. If we look at expectations around South Africa, what we would like to do is to start our presentation with a poll, the results of which Mikhail will elaborate on during his presentation. The poll will be coming up on your screen in a moment, and it has to do with expectations over the next few years regarding SA Inc. investments. And while you're busy filling in the poll, I leave you in the capable hands of Mikhail and John.
Believe the return will be from SA Inc. shares cumulatively over the next 3 years. You've got 5 options, and I will cover the results a bit later on in my presentation. As Annette said, I will contextualize the performance that we've seen, but also set up what we believe is an extremely attractive future from some of the asset classes that she highlighted. And I'm going to start by setting the scene. To set the scene will serve as a backdrop to this extreme positioning that we are seeing currently in the markets. And I'm going to start with the US election. So 2020 culminated with the US election. And what the US election showed and the events surrounding it was a deeply divided and polarized America. Now, it's not just America that's been deeply divided. Increasingly, we've seen divisions across political, religious, and economic lines. Extremities have really been pushed to the edge, and 2020 will be remembered for that. Social media has and continues to play a role here. Overall, we've seen a decrease in bipartisan behavior, and fringe views have become mainstream. Why am I mentioning this? Well, because markets reflect society, and not surprisingly, these extremes are evident in markets too. We've got extremes between developed markets and emerging markets, growth versus value, small cap versus large cap. And these extremes should be viewed in conjunction with the most notable extreme in modern day markets, interest rates. The chart that you see on your screen plots the yield or interest rate of the 10-year US government bond. The data stretches back to the year 1800. That's 220 years. The first thing you should notice is that currently we are at the lowest point in those 220 years. And if we view the US government bond as a proxy for global interest rates, what we are saying is that interest rates are the lowest they've been in 220 years. If we turn to South Africa, we have the repo rate, it doesn't quite stretch back 220 years, but we know that the repo rate at 3.5% is the lowest it's been in 55 years. So globally, interest rates are at all-time lows. Put another way, we are saying that cash is the most expensive it's been for all time. A few years ago, we said cash was cheap. You were earning real returns, interest rates above inflation from cash. That has evaporated. Now, we've known that for the past 12 years, since the global financial crisis, central banks have been driving down interest rates to keep economies afloat. But that movie never ended. In fact, it was accentuated during the COVID-19 response when governments around the world mandated lockdowns. That caused a demand shock to the system. And the first thing that central banks did was that they lowered rates further. Now, a knock-on effect of interest rates being as low as they are is that it boosts the valuation of most other asset classes. On this chart, we show what's commonly referred to as the Buffett indicator, referring to Warren Buffett, as he likes this measure to gauge whether stocks are expensive or cheap. And what the measure shows is the valuation of equities through the market capitalization against GDP, both globally and within the US. So the way to read the chart is that when market capitalizations approach a high proportion or even exceed GDP, stocks are expensive. When they are a low proportion, stocks are cheap. From this chart, the conclusion would be stocks are expensive. But I stress that these are markets at a headline level, a headline index level. The index, as evidenced here, or the one we've used is the S&P 500, is dominated by large cap growth shares, predominantly driven by technology, where valuations do appear stretched. But underneath the surface, there are still pockets of value. And especially if we look at other markets around the world, we see increasingly large pockets of value. Now, there is a distinct valuation discrepancy between value and growth, small cap and large cap. And in fact, prior to the recent rally that we call the small cap stroke value rally, which started in November, that divergence in valuations that we saw between value and growth was the largest on record. Now, that dichotomy between value and growth has been growing for a number of years, and it might prompt investors like yourselves to ask, what's going to change? And the key determinant or the key ingredient is that what's been missing from the market since that global financial crisis in 2008 has been wild speculative behavior. And wild speculative behavior is often touted as the most dependable feature of a late bull cycle. If there's one thing that 2020 and even the beginning couple of weeks of 2021 will be remembered for, other than COVID-19, it will be wild speculative behavior. When we think about speculation in the markets and the way it's portrayed in the media, the two names that sort of come to mind first are Tesla and Bitcoin. Tesla's valuation is now over 200 times earnings. You've seen the charts of Tesla being worth more than almost all the other car manufacturers in the world put together. And then we've had Bitcoin, which has continued its meteoric rise into the stratosphere in 2020, as investors have jumped onto the fear of missing out trend. But whilst Tesla and Bitcoin tend to get most of the airtime, there are numerous other examples which I'd like to point out to you on this slide, just to give you a flavor and a feel for some of the speculation that we saw in markets last year. I mean, to think we had cases of mistaken identities, where investors thought they were buying the video conferencing company Zoom that we are now so au fait with, but they bought another company that just had a similar ticker, a company by the name of Zoom Technologies. It's got nothing to do with video conferencing. The same thing was witnessed in the messaging application Signal when WhatsApp's privacy concerns had come to light. So we had mistaken identities. We then also had boom-bust moves in the likes of companies such as Kodak, Hertz, and Nikola, We had manic IPO behavior where stocks were doubling on the days that they IPO'd. We saw that with Snowflake and Airbnb. But I think what is now being presented in the media currently, it takes the cake of all of these examples. And that's the company GameStop that you see in the bottom left-hand corner. For those that don't know, GameStop is a physical retailer of games in the US and is almost a nigh bankrupt company. But a few weeks ago, it seemed to become to be in favor with investors. And over a matter of months, the share price went from $4 to $100. That's a 25-fold increase. But it didn't stop there. Within a couple of days, it went to $200. It doubled again. And then went to $300. And in fact, yesterday, it reached a high of $460 before crashing back down again. What is driving this sort of speculative behavior? Well, there are a couple of answers. But it's interesting that with casinos closed and much of sports betting being put on hold during the lockdown that we saw in March and April, retail speculators have turned to the stock market, armed with their government stimulus and zero-commission platforms, and have started to speculate on the market. Now, usually this type of behavior doesn't end well. The concept of heightened speculation was highlighted by Jeremy Grantham in his most recent letter, Waiting for the Last Dance. Jeremy Grantham is value investing royalty. At the age of 82, he spent more than 60 years navigating and understanding markets with a particular interest in bubbles and cycles. Now, looking at the photo, you can tell he's a value investor. In his latest letter, he calls out the mania that we are currently seeing in the markets, and he uses some emotive words: a fully fledged epic bubble, extreme overvaluation, one of the great bubbles in financial history. What is particularly interesting, though, is his advice. His advice is not to run to the hills and sit in cash. Instead, his advice is to invest in the overlap between value and emerging markets. That advice leads us to an interesting destination. That destination being South African mid-caps. On this chart, we've plotted the performance of the JSE Mid-Cap Index relative to the World Growth Index from 2002 to 2020. And an interesting story emerges. I'm going to explain this chart to you. The underdog, JSE Mid-Caps, believe it or not, outperformed the heavyweight Global Growth Index by a factor of 4 times between 2002 and 2016, an unlikely outcome. However, the subsequent 4 years were brutal, with the mid-caps halving on a relative basis. Much of that decline came in 2020. You will note that there's been a slight inflection point that talks to the value stroke small cap rally I mentioned a bit earlier towards the end of the year. And my colleague John will discuss that a bit later in his section. But if we extend on South Africa as a destination of that intersection of emerging markets and value, where we are seeing opportunity currently, we can extend it to a few other sectors and areas of the market. And in doing so, I present this table to you. On the left-hand side, we see what the market sees as safe assets, perceives to be safe assets. And on the right-hand side, what is perceived to be risky assets. However, when we look at the table, we see something different. We see the left-hand side as what has worked recently, and the right-hand side as what hasn't worked or what is out of favor. Following conventional wisdom and investing in the left-hand side means one is either taking an implicit bet that the future will look exactly like the past, or one is just adopting a passive approach, just buying the largest shares in the index. We caution that given the valuation differentials and the bubble-like sentiment referred to by Jeremy Grantham, risky and safe might be flipped around. And to visualize this table, we use the analogy of the Russian nesting dolls. That small doll at the end, that's South Africa Inc. over there. The most unloved part of an unloved market within an unloved investing style. I pause on South Africa Inc. because Annette asked the polling question, and I'd like to bring up the results to talk about what the forecast or what the expected returns are over the next 3 years. And the results will appear in front of me shortly. We have the results, and it's an interesting response. So the question we asked is, what do you believe the return will be from SA Inc. shares cumulatively over the next 3 years? And the options were negative 60%, negative 30%, flat, positive 30%, positive 60%. Interestingly, there's a favorite. The majority answer with 57% of the votes is positive 30%, cumulatively over 3 years. Flat being the next best at 30%. If we think about that forecast, positive 30% over 3 years is less than 10% per annum. It's better than the past 3 years, but we'd still argue there's a lot more that can happen to get those returns much higher. And even at a positive 60% over 3 years, that's only 17% per annum. There could be a potential scenario that we would see returns much higher than that, and I'd like to talk to you about that. So, I've set the scene, I've given you the backdrop. Let's talk about these equity opportunities that exist within that small doll, within South Africa Inc. And as a reminder, we follow the 3M-based approach when assessing equity opportunities. We want to find reasonable quality businesses, often underappreciated quality businesses, and then very importantly, we want to buy them for less than what they're worth. So the quality assessment, we look at the moat and the management to guide us, and by buying them for less than what they're worth, we want to have a margin of safety. Where are we most likely to find these opportunities? This is a busy chart, but what it shows is the cumulative 3-year total returns of the stocks in the all-share index, so the previous 3 years. The orange bars on the left-hand side represent the 10 largest companies by market capitalization in the index. Those 10 largest companies, on average, have doubled over the past 3 years. And on average, everything else, the blue bars, were negative. There's no surprise that we will be largely looking in the blue part of this chart in the orange, but also in the bars that are negative, the ones that have experienced pain, because there have been stellar performers in the blue as well. Those are mostly the platinum and gold companies, but the majority of index constituents have actually been negative over 3 years. And when focusing on index level performance, what gets missed is that dichotomy of what's actually happening underneath the surface. That area that we are focusing on, we see as a very fertile ground to be shopping from. However, we don't buy a stock just because it's fallen. We are acutely aware of the adage to not buy a falling knife. When stocks fall, we look for an underpin that can serve as a marker to value the company and assess further downside or risk. And one of the most useful dividends, or one of the most useful underpin at least, is dividends. On this chart, we plot the dividend yields on offer across a select number of shares. Here we use dividends that were declared in 2019, so before the onset of COVID in companies' results. And we plot those dividends against current share prices. We're seeing yields of between 7 and 16%. Annette mentioned the repo rate is at 3.5%. Dividend yields at twice the repo rate and up to 3 times doesn't make sense. Something has to give. Why is this the case? Well, the reason it is because come 2020, many companies temporarily suspended or deferred their dividends, and there was no yield, or there will be no yield for dividends declared in 2020. In the case of South African banks, they were forced to cut their dividends or guided by the South African Reserve Bank to do so. But many other companies acted out of prudence. Sure, there were some companies that will report no profits or even losses in 2020, so there wouldn't have been cash to declare as a dividend. But there are many other companies, and most of these that you're seeing on the table here, where cash generation in 2020 was robust. But out of prudence, management decided not to declare dividends. And that became the focus for investors. A yield that evaporated, no one's focusing on dividends anymore. But the point we would like to make is that the market is incredibly myopic. Because as we start to look out a year, and then another year, using very conservative assumptions on revenue recovery, we're not baking in pent-up demand into these equations. We start to see an interesting story emerge. And that's that 2020 pause in dividends was temporary. At some point, the dividends will return. And very soon, they will match or even exceed the levels that were paid in 2019. So for investors willing to look out a year, we have some of the most attractive yields on offer from a dividend point of view. All of the examples presented on the slide are attractive in their own right. But I'd like to pick out a couple for further discussion. And the first one I present to you is Old Mutual. In 2016, Old Mutual PLC, as it was known back then, embarked on a capital return strategy via a breakup of the company. It was called managed separation. And what it was going to do, amongst other things, is that the African business was going to be listed on the JSE, and it was in 2018, and it was going to be known as Old Mutual Limited. Old Mutual Limited then in turn began their own capital return strategy immediately. And the continued capital return via dividends, share repurchases, and unbundlings continues to be a cornerstone of the Old Mutual investment thesis. As we look out over the next few years, Old Mutual's profits are expected to be reasonably resilient and robust because they have dominant positions in certain pockets of the market, such as funeral policies, which are very high margin, very cash generative. Within Old Mutual, and this is an important point as I show you on the bar chart, the market capitalization is around 60 billion rand. But of that, roughly a third, 20 billion rand or so, is what we would consider to be excess capital. Capital that the business doesn't require to operate. That capital comes in the form of cash and it's holding in the bank, Nedbank. And what's left, that residual operating business side of the business, as I said, it is a reasonably robust business. And when we put this entire package together, we see Old Mutual being able to potentially match their 2019 dividend as soon as 2022. That provides us with a 5.5 times forward price to earnings ratio and a 10% forward dividend yield. Highly attractive, even in its own right, but especially so when put against a repo rate of 3.5%. That's inflation plus 6.5% from the dividend alone, let alone the re-rating and growth that might come after that. Another example, the JSE, our very own stock market. Globally, stock exchanges are regarded as very high-quality businesses. They generate high returns on capital. They earn most of their profits in cash. And they were able to attain these returns with very strong balance sheets. They don't need debt to boost their returns. Stock exchanges are effectively toll booths, earning a fee on all equity traffic that goes through it. So during periods of heightened volatility, like what we saw in the markets in March and April, these stock exchanges have a unique ability to generate counter-cyclical profits because more traffic comes through it. And the JSE is no different to global peers. It's a high-quality business that has consistently paid dividends to its shareholders. However, when it comes to valuation, the JSE gets bucketed as just another SA Inc. financial company. And therefore, it carries an SA Inc. type of valuation rather than one akin to what we're seeing in the global stock exchange universe. So coming back to those all-important dividend yields, the JSE currently offers a 7% dividend yield. That's more than double that on offer by the international peers. And it is a standout opportunity for us. Well, you may think that if we at PSG are so enthused by the JSE as an investment opportunity, why do you not see it in some of our competitors' top 10s, particularly our larger competitors' funds? And it boils down to us being able to exploit and seize the opportunity given our size. To illustrate, I'd like to share an example with you. Both our own PSG balanced fund and a balanced fund belonging to one of our larger peers holds around 260 million rand worth of JSE limited stock in the funds. That's between 2.6 to 2.7% of the market cap of the JSE. So we both own just over 2.25% of the company. But because of the size difference of the two funds, that holding in the PSG balanced fund is 3.3%. That same holding in a larger peers fund is 20 basis points. That's over a 17 times difference. Our holding, the same holding as these, but 17 times the size in the fund. And that's not only with the JSE. There are a number of other mid-caps listed on the exchange where we'll see similar scenarios. We are able to invest in it and still remain well within prudent limits in terms of what we own of the company, but they can move the needle for our funds. Interestingly, another anecdote I'll leave you with about the JSE. A few weeks ago, a SENS announcement came out. The JSE had to let their shareholders in the market know that Goldman Sachs, as the foreigners, have taken up a greater than 5% position in the JSE. So the foreigners have started to be drawn to some of these compelling yields on offer. And John, as a teaser, has a lot more to say about that. But it brings me back to the question, why it's important to bother. And I conclude with this slide. Why it's important to bother with JSE mid-caps if the larger peers don't own it in size and maybe the foreigners enter every now and then. Why is it important to bother? I'd like to take you back to the year 2000. And if we go back there and look at the fortunes of two companies that we see on this chart in the subsequent 13 years, we cut off at 2013, we see Company Gold has outperformed Company Black by a factor of 10 times. So Company Gold went up tenfold in that period. Company Black stayed flat. It may surprise you that Company Gold is the JSE mid-cap AECI Limited, which is a large holding in our funds. And Company Black is the almighty Microsoft, which, to be consistent, we've presented in rands. So over 10 years, AECI went up tenfold, and Microsoft in rands was flat. This highlights just how important starting valuations are. There's an expensive part of the market where valuations are very high. There's a cheap part of the market where valuations are very low. And I leave you with this question. How are your clients currently positioned for a scenario where we were to see history repeat itself? Ladies and gentlemen, thank you very much, and I now hand over to John Gilchrist.
Thanks very much, Mikhail, and good morning, everybody. Mikhail's talked you through the excellent opportunities we're seeing within select equities, where the low dividends for 2020 are masking a rebound in dividends, even if SA GDP growth turns out to be anemic. I'm now going to have a look and take you through the opportunities that we're seeing in the fixed income side of the market. So firstly, if we have a look at the fixed income market and we break it down into sub-asset classes, if you will. So we go from cash on the left-hand side, money market funds, NCDs, corporate debt, and then on the right-hand side, we have the sovereign bonds. Nominal bonds, we're looking at the 10-year over there, and inflation-linked bonds. And then what we've done is we have shown on the gold bars the returns that were available in these asset classes at the end of 2019, and in the darker bars, we show the returns at the end of 2020. And the impact of COVID is pretty clear and pretty dramatic. Mikhail referred to the significant drops that we saw with the SARB dropping the repo rate from 6.5% down to 3.5%, and you can see the impact of that on the left-hand side, with cash yields down at effectively 3.5%, and even NCD yields on a 3-year basis, and corporate debt also being pulled down. You'll notice the right-hand side, the 10-year bonds have stayed relatively high. And that's because, although COVID resulted in significant drops in the repo rate, it also raised concerns about sovereign risk. So there were additional costs associated with COVID, as well as a significant knock to GDP, which basically has put the debt to GDP number under pressure and raised significant concerns about the sovereign risk. And hence, those yields have remained high. As a result, we've got what is called a very steep yield curve, ranging from 3.5% with the repo rate and around that for cash, all the way up to nearly 9% if we have a look at the 10-year nominal bond. And so this very steep yield curve is significantly more than what we saw going back to 2019 if you have a look at the gold bars there. If we overlay on this chart the midpoint of the 3 to 6 inflation target that the Reserve Bank has, so we overlay a 4.5%, you can see that the sub-asset classes on the left-hand side are effectively going to struggle over the foreseeable future to actually deliver real returns, whereas bonds on the right-hand side still are likely to deliver very attractive real returns. Now, these big changes, this dispersion in returns, this very steep yield curve that we see, is not only driven by fundamental factors. There are also some technical factors at play. And so what we've shown over here is the cumulative, the rolling 12-month unit trust category flows. As an example, if you have a look going back to the Q3 2014, the black line there shows the equity-centric flows, equity and multi-asset funds, in other words, your balanced type funds. And back for the 12 months ended September 2014, we had an excess of 150 billion rand flowing into those equity-centric funds. At the same time, we had an outflow of over 50 billion from your interest-bearing and your money market funds. Fast forward to Q3 2020, and the situation has reversed 100 degrees. We now have over 150 billion flowing into those interest-bearing and money market funds, and significant outflows from those equity-centric funds. And what that has done is created an insatiable demand for those asset classes that we saw on the left-hand side, for your NCDs, for your credit, and that's actually helped pull those yields down. Credit spreads have been pulled down dramatically, and it's actually added to that high and steep yield curve that we've seen. Moving back to the fundamentals and the sovereign risk concerns that are out there, if one has a look at the trends on projected debt to GDP per the Treasury, it's no wonder that there are significant sovereign risk concerns. On the left-hand side, we've shown budget numbers going back to 2017, so the projected forecast for debt to GDP over the next couple of years. We've looked at it again in 2019 in the gold bar, and then finally the medium-term budget policy statement in October last year in terms of what was projected for debt to GDP. And it's an alarming picture, let's be frank. Back in 2019, the projection was that debt to GDP would peak just below 60%. It's actually quite interesting that for a long time, 60% was seen as a kind of threshold for emerging markets, beyond which debt would become unsustainable. We actually did work back at the time, and because of the very good structure that we saw in South African bonds, where the term of the bonds were actually one of the longest in the world, approaching 12 years at that time, and because only about 10% of the bonds were actually issued in foreign currency, we felt at the time that South Africa could peak at north of 70% debt to GDP without getting close to a debt sustainability issue. Ultimately, debt sustainability is about what the market will allow you to get to, and whether the market's comfortable with funding at those sort of levels. So fast forward from 2019, we obviously had significant issues in terms of growth not coming through. We had increasing costs, primarily on the public sector wages. And we also had the significant costs coming through from SOEs, and primarily in the form of Eskom. Add to that the significant impact of the costs associated with COVID, as well as that estimated 8% drop to GDP, and suddenly you're looking at a projected debt to GDP peaking in 2025, 2026 at about 95%. Now you may say, well, a lot of countries, most countries in fact, have seen COVID negatively impact their outlook for debt to GDP. And actually there are a lot of countries that also run really, really high debt to GDP numbers, significantly higher than the projected 95% that we're seeing there. But there are two things that make it particularly important to look at this from a South African perspective. Firstly, as we've already indicated, the cost of our debt is very high. You're looking at almost a 9% yield on the 10-year nominal government bond, and a significant yield if you could translate that into real returns. So that's the one aspect. But probably also incredibly important is the fact that our growth outlook is under pressure. And what we've got on the right-hand side of this chart is the SA Business Confidence number on a quarterly basis. And you can see, yes, after the significant smack it took during the height of COVID back in 2020, it has rebounded, but it's still effectively at the same low levels that we saw in the early 90s. And without confidence, you're not going to get investment, and without investment, you're going to struggle to get the growth that we need. Ultimately, if we summarize it, belief in government willingness and capacity to address key issues is at rock bottom levels. But before we get too depressed, let's just take a step back. Clearly, there's a lot of people that are very concerned about what's been happening in terms of government's lack of progress on key reforms that are required. And I think that's just been exacerbated through the COVID crisis with some nonsensical policies, and now it appears the total bungling in terms of the vaccination rollout. But ultimately, what's incredibly important to focus on is that if you have strong institutions, they are absolutely key in avoiding a failed state. And we thought it was quite interesting to have a look and do it visually. Go back to 2017. Have a look at who was leading up some of the key institutions in South Africa and compare them to today. And we often forget how changes happened, how positive steps have been taken. So if we have a look at SARS, we go from Tom Moyane through to Edward Kieswetter. Finance Minister, Malusi Gigaba, now Tito Mboweni. If we have a look at the SOEs, Machela Koko through to Andre de Ruyter. And then on the NPA, Sean the Sheep Abrahams through to Shamila Batoyi. And also if we have a look, we've got a robust and free press, we've got free and fair elections, and we've got judicial independence. And these really are key things where we've seen significant progress. And I think if we were able to take ourselves back to 2017 and we were able to look at a slide like this, I think we would be very pleased indeed. And of course, I neglected to mention Governor Kiniako, a very, very safe and credible pair of hands at the South African Reserve Bank. If we model the potential outcomes of debt to GDP under various scenarios, we come to the conclusion that cost cutting is important, and it's particularly important in terms of creating confidence that will ultimately drive investment. But in terms of that outcome and that projection, growth is absolutely crucial. So what we've shown here is a situation where I'm just going to highlight the gold and the black bars, lines. Firstly, the gold bar being a situation with 1% growth and 300 billion rand of cost cutting. That is not sufficient to stop that debt to GDP line continuing to move up. Conversely, if you have 2.5% long-term growth and zero cost cutting, that debt to GDP peaks and starts to come down. So growth is absolutely crucial, and if you think about it, the reason for that is higher growth leads to higher tax revenues. Higher tax revenues means we need to borrow less, so our debt is lower than anticipated. And on the flip side, higher growth clearly boosts GDP. So if you have higher growth, the debt to GDP ratio can actually come down quite quickly because both the numerator and the denominator are positively affected. Now, when you talk about growth, anything the government is putting out at the moment will refer to the Economic Reconstruction and Recovery Plan. Now, that's projected by the Treasury to potentially drive South African growth to 3% or more over the next 10 years. If you have a look at the underlying tenets of this recovery plan, and you have a look at what could practically actually be implemented under a COVID type of scenario that we're in right now, you end up focusing on two key pillars. The first one is infrastructure, and the other one is energy. Now, we've previously said, and some of the big frustrations have been that the government tends to talk the talk, not necessarily walk the walk. But what's interesting is when we have a look at those two areas, we know that 12,000 megawatts has been included in the Integrated Resource Plan of 2019 in terms of independent power production. There's also been an emergency 2,000 megawatts that was put out to tender to basically help the grid at the moment. So we do know that these sort of things are moving ahead. The processes are in place. If we have a look at the infrastructure fund, government's looking to build up a fund of about 100 billion rand in terms of government money, and then leverage that up through the use of private partnerships to get about 1 trillion rand of infrastructure investment available over the next number of years. We know that they've identified already 257 projects with a funding shortfall of 500 billion rand. The infrastructure will incorporate things like student housing, 12 harbors, hospitals, border posts. Now, up until now, this is potentially just talk, once again, with no action. But what's really interesting is, in the last couple of months, in interactions that we've had with CEOs of companies that are directly involved in these sectors, where there's energy or infrastructure implications, they are significantly more positive on the outlook because they're starting to see the tenders coming through. And they're starting to see the public-private partnerships going ahead. And that, for us, is a potential indication that the government is moving from talk through to walk, which is incredibly important and a really optimistic sign for us. In summary, make no mistake, South Africa is in an incredibly tough fiscal position. But what's key is that a fiscal crisis is not a foregone conclusion. There are a number of scenarios, as we've painted here, where even at moderate growth levels, that debt to GDP starts to come down and we avoid a fiscal crisis. What's interesting for us, though, is if you think back to those bond prices with 10-year bonds at nearly 9%, essentially they are pricing already as though a fiscal crisis is a done deal. And therefore, it's not surprising to you that we see bonds as attractive. To illustrate just how attractive we see those bonds, we thought we'd have a look at the R2032. This is a sovereign government bond maturing in 12 years, and it's currently yielding 9.7%. So you could buy one of these bonds today, and for the next 12 years, effectively, you're going to get 9.7% per year versus cash at 3.5%. So that immediately looks quite attractive. However, that steep yield curve that I referred to earlier, with the repo rate at 3.5% and 10-year yields nearly 9% and 12-year yields at 9.7%, creates an opportunity to do even better. If nothing changes, if the yield curve stays the same and you literally just buy this bond and hold it for 2 years, you can get returns in the order of 12% per year over the next 2 years. Now that's effectively CPI plus 8. It's a real return of 8%, which is a good return over the long term from equities, which are generally expected to do 6 or 7% longer term in terms of real returns. So from this bond, you've got the potential over the next 2 years, with nothing improving, to outperform the long-term expected real return from equities. But as I say, that's not all. If you flip it around and you say, what happens if this bond moves back to the effective highest yield it's ever been at? What would we return under that negative scenario? Well, actually, you would return about 3% per annum for the next 2 years, or only about 0.5% per year behind cash. So not only is the base scenario incredibly compelling on a bond like this, but the risk-reward trade-off is also squarely in our favor. Now we've touched, Mikhail on the equities, myself on the fixed income side. We've touched on potential returns that we could see under a base case scenario, if you will, where the outlook for South Africa remains poor and our assets stay unloved. And even under these scenarios, the return potential through the high yields is still pretty compelling. But a key question is, what happens if the outlook improves? Or another key question that people often overlook is, what happens if the outlook actually stays quite poor, but very importantly, global sentiment improves or global risk appetite actually returns? What is the upside potential? Now, before I delve into that, I just want to touch on just how unloved South African assets are. So if we have a look on the left-hand side, we've got local pension funds. You can see that top line, the dark line there, indicates the equity exposure in local pension funds. And you can see that's actually at the lowest level. If we were to go further back, it's at the lowest level since the 1980s. And that hasn't been due to selling of offshore equities. That's due to selling of local equities. We have already seen, if we look at the bottom, those significant outflows that we've seen from unit trusts, 250 billion into interest-bearing and money market funds, and 145 billion out of equity-centric funds. And then on the right-hand side, what about the foreigners? Foreigners can be key drivers of our market. Since July 2015, foreigners have sold nearly 500 billion rands worth of South African equities. They've also sold nearly 160 billion rands worth of South African bonds. It's very clear that the consensus view out there is to avoid South African equities in particular. Now, the obvious question is, well, what happens when a consensus view is suddenly challenged? And we've actually got a great case scenario, an example of what happens when out of the blue consensus is challenged. If we go back to early November last year, we were all focused very squarely on what was happening with the US elections, and suddenly Pfizer came out and announced that they had a 90% efficacy vaccine that they had taken through trials. When that happened, suddenly markets looked through to a world potentially beyond COVID. They suddenly looked through to a world where there could be growth, and the sectors potentially delivering that growth were not the same as those that were able to deliver growth during a COVID pandemic and during a lockdown. We saw the US 10-year bond yield move from 80 basis points to just over 1%. Not a huge yield in the bigger scheme of things, but suddenly it brought into question the narrative that interest rates would remain rock bottom in perpetuity, and hence that growth assets would be a fantastic opportunity in perpetuity as well. On that single day, we had a number of shares in our portfolio jump by more than 20%. Subsequent to that, we've seen the announcement on the 16th of November of the Moderna vaccine, and then initially, surprisingly, if you look back at the end of the year, it certainly wasn't a given. The Democrats secured control of the Senate early this year. And obviously, they're looking to put through a $1.9 trillion stimulus package, fiscal stimulus, which could potentially also change the outlook significantly and cause reflation. What happened on some of the established trends over the short term? Well, firstly, we saw small caps suddenly start to outperform for the first time in many years. What I've got there is the green line is the S&P 500, and then the gold line is the Russell 2000, so in other words, small caps in the US. Significant outperformance from small caps. We also saw for the first time in many years tech underperforming the overall market. Now you might say that's not a massive underperformance, but remember that tech and even just the big five are roughly 24% of the index. So that is actually quite a significant underperformance that we saw over this short period. If we have a look at value, you can have a look at financial shares there outperforming quite significantly, and then our own PSG Global Fund in dollars, after having had some period of underperformance, some significant short-term performance coming through there. If we go to what's happened to the question, what's happened to those huge foreign flows that we saw, we answer that by having a look at the cumulative foreign flows over the year 2020. And initially back in March, actually globally, it was the biggest outflow from emerging markets on record in March. And you can see that big pull down over there. But actually what's interesting is bonds, we started to see them turn around in November. And December was the largest monthly bond inflow for nearly 3 years. Equities took a little bit longer. We only started to see inflows happening in December. But once again, that was the first monthly equity inflow in 18 months and the largest for 3 years. Now, we're not saying that this is definitively an inflection point. There's clearly a lot of COVID-19 related uncertainty still out there regarding mutations, regarding the rolling out of vaccinations, and politically there's still issues in terms of the approval of the $1.9 trillion US stimulus package in the US, for example. But it really does remind us how quickly sentiment can change, and because of the extreme positioning that Mikhail referred to, what a dramatic effect a change in sentiment can have on asset prices. The other thing is we tend to, as South Africans focus on the challenges facing South Africa. And we forget two absolutely crucial things. Is firstly that asset prices can move without a significant change in the underlying economy. In fact, they can be out of sync with each other. Who would say that last year was clearly a tremendously tough year from an economic perspective? Our market was up 7% overall. Another key point that we constantly forget is that you've got foreign investors living in a zero interest rate world, and they're constantly looking for opportunities to generate outperformance. A small bit of positive sentiment, a small change in the risk-return appetite could bring some of those foreigners back to our market. The other thing is that a lot of these trends have been in place for many, many years. Yes, we're not calling this an inflection point, but we do think the odds of a change is imminent. The obvious question is, well, what happened to South African shares during this short period that we're having a look at? So we took a selection of so-called SA Inc. shares that we hold, and we had a look at how they performed over the short period from the 7th of November through to the 14th of January. And you'll see on the left-hand side there, certain shares bounced and bounced aggressively. We had AdCorp up over 100%, Invicta up nearly 50%, and Sogo Gaming up about 40%. But some of the other shares on the right-hand side, the likes of Hudayco and Imperial, actually lagged during this period. Now what's interesting is those on the left-hand side are pretty illiquid shares, and you can argue that some of the bounce was just a difficulty in terms of getting that stock and having to move the price in order to actually pick up that stock. But in the context of 500 billion rand having flown out of South Africa over the last 5.5 years, if even a small amount of that started to come back into the market, we would think that some of the mid-cap shares that are not necessarily as illiquid as an AdCorp, but are relatively illiquid in their own right, those could be significantly moved by foreigners coming back into South Africa. Just to illustrate this for you, we've had a look at one of our small cap shares. This share is projected to have a dividend yield for 2021 of roughly 10%. The earnings and dividends are expected to grow between 8 and 10%, relatively conservatively based on our analyst estimates. And this share currently trades on roughly 5 times price-earnings ratio. The historic average is roughly 12 times. Now, if the share were to re-rate over the next 3 years, you could get a return of 62% per annum for 3 years from this share. And we have a number of shares that are in a similar type of position where we see tremendous upside if we were to see the start of a trend or a continuation of that short-term trend I already alluded to. On the bond side, just for completeness, we mentioned the roughly 12% return you could get under a status quo scenario, but if yields were to drop, you could quite conceivably generate returns of more than 15% per year from these bonds, and we've already seen how attractive the risk return is relative to cash. I'm now going to move on to fund positioning. Given we've talked both about equities and the fixed income side of the market, it makes sense to focus on the balanced fund. On the left-hand side, we have the balanced fund. We've looked at the physical asset allocation here at the end of December, and we've lumped property in with equities. But what you can see is a nicely diversified portfolio. SA Inc. is about a third of the portfolio. We've got nearly 20% in rand hedges, and then nearly 28% in offshore equity and property. And then we've got about 18% in bonds. Now, sometimes we get lumped in and people sort of see us as small cap value managers, and we certainly don't see it that way. If we have a look at some of our shares and we actually unpack exactly what characteristics they bring to the portfolio, firstly, we have a number of shares with significant rand hedge characteristics that tend to be lumped in as SA Inc., the likes of AECI or Imperial, for example. Then we have a number of shares where their growth prospects are not linked to the prospects for South African GDP. Mikhail referred to the JSE as one good example in that space. On the top left there, we have a number of shares that are very high quality shares, previously were darlings of the market. They've fallen out of favor, and we've been able to buy them at levels that we feel offer us the appropriate level in terms of margin of safety. And then we have a number of shares that are simply deeply mispriced. Moving on to the balanced fund's top 10 equity holdings. A number of these will be familiar for you where we've held them for a number of years. I just want to focus on two key shares here. Firstly, Anheuser-Busch ABI InBev. You can see there in the end of 2019, we had a very small position in the fund, only 20 basis points, and that at the end of December was all the way up at 3.7%. Now this is an example of a share, very, very high quality. We think it's got an exceptional moat, very, very good management team, but it's historically been too expensive and hasn't warranted us actually buying it. Remember our 3M process and that focus on margin of safety. Back in March 2020, during the height of the COVID fears, this share sold off 42%, and we were able to buy this share. A lot of the concerns in the market at that point were around the very high level of debt that ABI had. At that point, they were looking at roughly $96 billion of net debt. However, when we looked at that carefully, firstly, that debt is incredibly well structured. They've got debt that matures only in 2059. A lot of that is long-term debt, and they also are very, very active in terms of keeping the window clean, making sure that they roll out debt before it becomes due. The other key thing was that even under a COVID scenario, it was still a highly cash-generative business. In fact, we calculated that the cash flows from the US business alone could actually service all of the debt. And so having discharged that concern about the balance sheet, we were able to buy into the share quite aggressively, and it subsequently rallied very strongly and been an excellent contributor to our funds. Another interesting share that I just want to focus on there is Tanger Factory Outlet Centers. It's a US-based retail property company. And given the narrative that we've had for the last couple of years around online dominating and malls and retail property basically being a dinosaur, this share has come under significant pressure. What's interesting about this share is it's an outlet factory center. It has 39 different centers across the US and Canada. And actually, most of the retailers see factory outlets as a key part of their distribution strategy. It sits alongside online, and it's a key part of omni-channel. If you think about it, if you want to get rid of some stock, you don't want to post it up on the internet and let everybody know you're willing to sell it for a lower price. You'd much rather do that physically through a factory outlet. And actually what we've seen is because these factory outlets have this unique marketplace, and because they generally are outdoor stores, the footfall has actually been a lot better in the latest numbers in the US than certainly we've seen for malls. But what's really interesting about the stock is because of that narrative, the short interest on the stock was roughly 49%. And this stock is one of those shares that's actually been caught up with the GameStop hype. And last night at one point it was up nearly 100% month to date. Very, very volatile, but one that's nice to be on the right side of what's happening there for us. In terms of our portfolio strategy, we favor domestic shares, including small and mid caps. We favor select global shares. There's certain resources and materials companies that we do like. You would have seen Glencore as one of our largest holdings. Also a very, very strong performance over the last 3 months. And we favor government bonds. We're avoiding credit, both local and global. We're avoiding global bonds. We don't like the expensive momentum-driven shares. And as Mikhail alluded to, cash is the most expensive it's been in 55 years. We think what's key is with these extreme markets, you really need to have an open mind. We believe a lot of investors have capitulated. They've sold those so-called risky assets to buy the past winners. So they've been buyers of large cap, they've been buyers of growth, they've been buyers of tech and US shares. We definitely don't see this as a low-risk strategy. We see it as exactly the opposite. We're taking a longer-term view. We're focusing on out-of-favor areas, and we're using those extreme conditions to buy great businesses at fantastic prices, ABI being an obvious example of that. In conclusion, we don't believe the current market extremes are likely to persist. I think Q4 was a taste of what could happen if there's a change in consensus view. We do think longer term that change will become more locked into the markets. And a key question for you is, are your portfolios positioned for a change in consensus view? There are segments of the market that appear overvalued, but we do believe the sustainable yields that we've referred to create a nice risk underpin, and as a result, we're able to get attractive returns at reduced risk and still have that upside potential from a re-rating or if growth were to come through. With those high yields, we're essentially being paid to wait. We don't need to try to time a potential re-rating coming. And then finally, although we do acknowledge South Africa faces significant issues, it's once again absolutely crucial to remember that these don't need to be fixed in order for South African shares and for South African bonds to deliver exceptional returns. Thanks very much. We'll now take some questions. So just having a look through the questions now. Mikhail, would you like to take the first one there? The question is, why are you not holding any global tech shares or Naspers? It seems like a big gamble. I think we expected that one to come up.
Yeah, sure. So extending on what John showed, where we are finding opportunity versus what we are avoiding, tech and these global tech shares, including the likes of Tencent, which obviously drives the Naspers share price, would be considered to be one of those momentum plays or the most crowded areas of the market, if you will. When we sit back, we think to ourselves, if the trade is that crowded, what is the likelihood that we would be finding a mispricing? Notwithstanding, we look at valuations very, with a fastidious approach. Starting valuations matter to us. We've shown charts previously of subsequent returns of various valuation metrics. And typically, high starting valuations lead to very poor subsequent returns, and inversely, low valuations tend to correlate to much higher valuation returns. Worthwhile pausing on this because it is a very important question. But as John mentioned, and I also touched on it in my slides, we look for quality that doesn't appear to be in the market's view, rather than what the market views as being quality that could actually turn to be the opposite. And what we do caution about tech is that the elephant in the room is obviously regulation. We've seen little tastes of what regulators are looking into, most notably privacy when looking at the US and the European regulators. And then, of course, in China, there's been a clampdown and crackdown on certain shadow banking activities, as we saw most recently with Alipay, which sits within Alibaba, and then WeChat or WePay sitting within Tencent. So there is this tail risk that we feel just doesn't get enough airtime. So the combination of high starting valuations, the fact that it's a very crowded trade, as well as tail risk, there's not that underappreciated quality that we look for, has led us to not invest in them now. It's not to say we will never invest in them. We have owned tech in the past, and we would love to, but at lower valuations. John, I think we have a little bit of time to tackle another question. So I'll read you the next one that comes up. It says, some South African property companies have announced that they will withhold dividends. Do you hold any South African property exposure in the multi-asset funds?
Yes, I'll answer that from the perspective of the balanced fund. So yes, it's very interesting in terms of property companies. They need to distribute 75% of their earnings effectively. And obviously under a situation with COVID, their loans to value are under pressure. They're starting to move upwards, and they still effectively have been forced potentially to pay out those dividends at a time when they actually want to be holding on to that cash. What's interesting is last year, I believe it was Texton withheld the dividend, and then more recently, Redefine also withheld their dividend. And the reason they did that was that there are two key criteria on which they can withhold dividends. The first one is on solvency, and the next one is related to liquidity. Now, they don't have necessarily a specific liquidity issue right now, but their argument would be that if they pay out the dividends, their loans to value will move too high, their bankers will become concerned, and that could create a liquidity issue. So it's potentially, I guess, a bit of a loophole there. In terms of the rest of the question, so the SA REITs Association is taking this up. As I mentioned, Redefine has decided not to pay a dividend. And certainly from the overall property perspective, I think it would take some potential selling pressure off that market in terms of the need to bring down the loans to value, which has really can only be done by selling some of those property holdings. In terms of our funds, we actually have about 5.2% on the balanced fund in global property shares. I mentioned Tanja, we also hold Simon Property Group. And then locally, we just have a small holding there, about 1.4% in the balanced fund. The bigger holdings there are Attack and Growth Point, where we've started to see some opportunities. We're still quite cautious in terms of how they resolve the loan-to-value issues. We saw Growth Point having essentially an issue of shares, and we think there could be more coming, but they are starting to look quite attractive. We obviously need to weigh them up against the other opportunities that we're seeing there.
Good. I apologize that our time has come up. We couldn't answer all the questions that have been asked, but please send your questions through to your representatives and we will respond via email. Ladies and gentlemen, thank you very much.
Thanks very much.
Everything I don't want to show. Perfect day for leaving me. It's breaking, but I don't want to know. The world inside my head. Worlds around the things you said.